Good afternoon to everybody. And first, I would like to apologize for my delay and not being here this morning when it was the time I was supposed to speak, and to thank everybody for your patience and for being here to listen to my presentation, and also to all the previous speakers for their flexibility in adjusting and accommodating me. So thank you very much, everybody. And thank you, all of you, for giving me the opportunity, and as well as IAIS-ASSAL and the IAIS for giving me the opportunity of presenting this work on mortality assumptions and longevity risk that we have been carrying out at the OECD, at the Working Party on Private Pensions, and the Insurance and Private Pensions Committee during the last 2 to 3 years. There are some leaflets in the back. If anybody wants, there is only a one page, is the executive summary of the publication. This publication came out in December, and I'm going to present the main results of this analysis. I'm going to explain what we do in this study and the main implications and policy recommendations on these studies. In the OECD, normally what we do is we analyze a problem. We try to understand the sources of the problem, the solutions that countries have put forward, and then we come up with main guidelines or policy recommendations, and here we do exactly the same. This is the publication, and the main objective of this project was to respond to the challenges that longevity risk poses to pension systems, pension funds, and also to insurance companies as long as they provide annuity or life annuity products. Obviously, what we define as longevity risk is the risk that individuals live longer that is assumed or accounted for, and therefore pension or annuity payments, whether it's annuity providers or pension funds, or governments providing pay-as-you-go pensions, will have to be made for a longer period that has been planned or has been provisioned for. So this is what is longevity risk in the context of this study. And the approach that we do is we look first at the mortality assumptions that are used by pension funds and annuity providers in different OECD countries. Sometimes they are the same, sometimes they are different. That's why we look at all of them. And then we use them to determine how long pensions or annuity payments are expected to be made. And what we do is we assess the level of mortality today, the improvements in mortality that will happen tomorrow, the expected increase in life expectancy, and we also assess whether pension funds and annuity providers are exposed to longevity risk. And the final thing is we discuss different policy options to manage longevity risk. So we look at what pension funds and annuity providers do. Then we assess whether what they do carries some longevity risk for them. I will explain how later on. And in case they are exposed to longevity risk, we discuss how can they manage this longevity risk and what can they do about it. So these are the contents of the publication. It's structured in the same way, a little bit disaggregated, but that's the main structure. And the main messages are that the regulatory framework does not always require accounting for mortality improvements. Standard mortality tables that are used by pension funds and annuity providers are not always sufficient given recent trends in life expectancy. So pension funds and annuity providers do not normally use tables that are required. The tables required by the regulatory framework do not always account for improvements in mortality in many countries. Then, even if they use tables, sometimes they are not sufficient given the recent trends in mortality. So that's where the longevity risk might come if they do use appropriate tables. And we also discuss about how to manage longevity risk. And the main message is as regulatory or policymakers should ensure that pension funds and annuity providers use regularly updated mortality tables which incorporate future improvements. You have to use mortality tables that incorporate improvements and that are regularly updated. The second message is capital markets can offer additional capacity to mitigate longevity risk by addressing the need for transparency, standardization, and liquidity. And the main recommendation is that the type of financial instrument that should be used to address transparency, standardization, and liquidity is index-based financial instruments. And I will discuss a little bit about it on this. The regulatory framework should be structured in a way that recognizes the reduction in risk exposure that these instruments do. In many countries, sometimes pension funds or annuity providers use financial instruments to mitigate or to hedge risk, but is not recognized in the regulatory framework. And governments could facilitate transparency, standardization, and liquidity, the three issues that I said before, by issuing longevity index to serve as a benchmark. We do not talk, I will talk later about longevity index bonds, but what we say is government could help by issuing longevity index bonds. So this is what we do, and the main messages in the study, they are basically summarized in this leaflet, and now I'm going to try to develop them, focusing on the three areas, which we address three questions. What is the regulation, the current regulation and the market practice with respect to the tables that are being used? Are the standard mortality tables used sufficient? So the first one is what is being done? Are they sufficient given recent trends? And the last point is what are the policy implications of what is going on? This is basically what we do. What they are using, what they are doing, whether that is enough or sufficient given recent trends in mortality, and what are the policy implications given the first 2 points. That's basically the structure of the whole study and where the recommendations come from. So let me focus on the first part. In the first part, basically what we have here is first we look at whether the regulatory framework, the regulatory mortality tables, whether they have a minimum level of mortality assumed. We also look if there are regulatory requirements to account for future improvements in mortality. So we look at those levels at the different countries, and this is what we have for all the countries. Whether there is a minimum requirement, meaning there is a regulatory table that they have to use, or they can use a regulatory table, but that is different, but it has to be at least more conservative than the minimum regulatory table. This is what different countries do. And then whether they include those regulatory tables, whether they include improvements in mortality and life expectancy. And what we have is that minimum requirements are more common for pension plans. We expected that because the whole solvency funding ratios in pension funds. And half of the countries have no requirements to account for mortality improvements for both pension funds and annuity providers. So there are no requirements in half of the countries to account for improvements. So we also look at the market practice, because in some countries, not in every country, but in some countries what the pension funds or annuity providers can use different tables than the ones that regulation requires. They have to be more conservative. And in some countries, as we say, there are no regulatory tables. So we look at what the market practice is in different countries for pension funds and annuity providers, and we do exactly the same. And we will find out is most countries account for future improvements in mortality in practice. So that was reassuring to us. Also, annuity providers tend to assume improvements in mortality tables more often, or in the mortality tables they use more often than pension funds. That was not that reassuring because there are a lot of problems in pension funds, in particular in defined benefit world, but that is what we find. So that's the answer to the first question, what countries do, what pension funds and annuity providers do in terms of market practice and regulatory tables. So then what we do is we assess if these tables that are used, whether the regulatory tables or the market practice, are used by pension funds and annuity providers are sufficient given recent trends in life expectancy to account for future improvement. So basically we assess whether there is any potential for longevity risk. So basically, the idea is that we assess the value of the additional reserves that needed to meet future pension annuity payments given the differences between assumed future mortality and expected future mortality. What we do is basically we look at the mortality tables that the regulatory framework requires and the ones that they use, and we compare them with what the mortality improvements using 4 standard projection mortality models will suggest that they should be using, and then we compare. So that's how we assess whether there is some degree of longevity risk that pension funds and annuity providers might be exposed to. The metric we use is we compare life expectancy and annuity tables given the mortality improvements that those mortality projections model suggest for each country with the life expectancy and annuity values that the mortality tables used by pension funds and annuity providers suggest that they have implicit in their reserve calculations. As I said before, what we measure is the length of the payments and also the annuity value, the expected differences in the cost of meeting the payments between the two. So these are the metrics that we use. Obviously, they are driven, the differences, by the length of the payment, which is the mortality, and also the time value of money, the discount rate. Obviously, what discount rate we use here is very important. Now there is a lot of discussion in the world about whether we are moving into a world of low interest rates, low returns, and low inflation and low everything or not. But we also assess how all of this varies when the time value of money changes, the discount rate. But these are the main factors. But we are going to focus on the mortality because it's the main goal here. But in the study, we also assess the sensitivity of the analysis to the discount rate. Anyway, that's the forming expectation, quantitative outputs, and qualitative judgments. Obviously, we use projections models, as I say, to compare. We use the Lee-Carter, the Cairns-Blake and Down, the P-spline, and the CMI model. These are the 4 of the most standard models. They are mathematical models, the model that demographers use. The CMI is the one that is typically used by the Insurance Company Association in the United Kingdom. The P-spline, the Lee-Carter is used a lot in the demographic world and in particular in the US. The Cairns-Blake and Down is more a stochastic model, like the Lee-Carter. The other 2 are more deterministic. In the interpretation of the results, we assess the pros and cons of each of the type. There is a whole chapter analyzing that. I'm not going to go into the discussion. And we also have to take into account the historical context. Like, for example, when we look at countries like Chile or Korea, the improvements in mortality has been quite large in the last few, in the years that we have a sample. But obviously, if you extend them from the next 50 years, the improvements in mortality and life expectancy will put these 2 countries in a much better place than say, countries like Germany or the UK. So obviously, when you look, for example, with Korea, we assess it comparing with Japan. Japan in the 60s and 70s has big improvements, but obviously those improvements smooth out over time as they reach high levels of life expectancy. So we assume that this is also going to happen in that way to some of the countries. So this is the idea that we had before, that we also use qualitative judgment in forming the expectation, quantitative outputs and qualitative judgments, because that is important. And all of this is described in each of the country chapters or sections in the publications. So then the population mortality, we use population life expectancy versus pension annuity and life expectancy. This is something very important to assess. We look at the mortality differences relating to socioeconomic factors. Not every country has this information. Actually, only 4 countries that we examine have this information. Level of difference depends on the structure and coverage of the pension system. Obviously, a mandatory pension system, the difference between the population and the annuitant pensioner life expectancy is going to be minimal because everybody has to be in the system. In systems that are voluntary and certain groups or socioeconomic groups of the populations are the ones that buy life annuities or have pensions, then the distinction between the population and the pension annuitant life expectancy becomes more important. So that is important to understand the differences of the pension system and the coverage in different countries. So we need to, when we compare, we need to adjust for the differences. We start and we assume that we start at the same place. So because we are assessing the actual mortality tables that are being used, or that the regulatory framework. So we start from the same point that the mortality tables in the projections model, because that's the only way we can really compare in a fair way. So we assume mortality experience used to create the standard tables was accurate representation of the pensioner annuitant mortality. So we take the tables that countries and regulators use, and we start from that. We assume that this is accurate, and we assume that they evolve in the same way, and we assume that the same proportional decrease in mortality in both populations, in the pensioner annuitant or in the total population, will happen. Obviously, in some countries this is not a problem. In other countries it's a problem. We also, we have assessed what magnitude this problem might have in a few countries. In some, it's not really seriously a problem, but in others might be a problem, and we try to address. Basically, the idea is, this is the population, the projection of the population improvements. This is the improvements of the pensioners or annuitants. And then what we do is we apply to the starting point the improvements that we had in the projections model. So this one, and this is going to be a measure of the longevity risk. This is what the mortality is assumed, the underlying mortality improvements in the tables, and this is what, from the same starting point, using the population, using the mortality projections model. So this is the basic idea. This is an example that we do for Spain. One country is not Spain because I'm Spanish, it's just Spain because my co-authors thought the example of Spain was quite interesting. But basically, here are the Spanish tables. This is the projections you get with the population. This is the projections using our methodology, and it shows that obviously there is a higher life expectancy and higher annuity factors using our approach, which is a measure of the potential mortality, longevity risk that it has. This is the data with the heat tables for the different age, and this is the mortality used by the Spanish authorities, and this is what the different projections model will suggest. And obviously here the whole assessment of the difference of the models come to place. Obviously the P-splines is the one that seems to be closer to the actual data, because the way it's structured, this model is taking into account, is giving a larger weight to the latest improvements. But as we do through all countries and all the assessment, we use 4 models, and we know the pros and cons, as I said before, about the models, and that also gives us some richness in order to assess what is going on. So this is the final table with the results of the potential shortfall on pensions annuity provision based on the standard mortality tables for all the tables that are used in the different countries for pension funds, pension plans, annuity providers, and we classify them using the typical traffic lights between going from okay to serious. And basically, serious is when the shortfall is bigger than 10 and it goes to 20% in the worst case scenario. And this is the classification, and here are all the tables. If anybody wants to discuss or want to look in the publication about the different countries, their own countries, is everything in in the publication. Obviously, the country that comes out, there was somebody from Brazil in the session before. One of the countries that comes out is Brazil and China. Switzerland, as a result of this, has improved their tables, so we work directly with them to improve their tables because they were part of the analysis at the OECD, and they realized that one of the tables had a lot of problems. So we were very happy that our work and our discussion with regulators across all OECD countries led for this kind of adjustment. We are also collaborating with the insurance and the pension regulator in Chile to do the same kind of a study and produce mortality tables based on that, have an assessment. And we are also starting to do the same kind of assessment with other countries to develop their own tables based on all this methodology. But this is what it comes out. So we have seen what countries do, an assessment of the amount of longevity risk that pension funds and annuity providers might be exposed to given what they do, the mortality tables they use. And now the final part of the analysis of the publication of the work is to look at what are the policy implications or how to manage longevity risk. Okay, this is not the presentation I had prepared, but anyway, I had this is the presentation you all have. This is the one that was distributed. I just make a few changes. Basically, what I did is I introduced a slide saying, well, the first step is how to manage longevity risk. And obviously, you can manage the longevity risk through the actuarial process. So basically, it's very important because through the actuarial process, you can manage it internally. You retain risk and hold enough capital to withstand any fluctuations. But the key important thing here is that the actuarial evaluation process, the key goal is to account for the expected improvements in mortality and life expectancy. And this is the point that is here. It's essential to distinguish between expected and unexpected. The second way to manage longevity risk is to use financial instruments to mitigate or to hedge longevity risk. And the main goal of using financial instruments to hedge is to address the unexpected component of the risk. So this is the other slide that I have here. And the important thing here is that you can do it either internally, you can do it through financial instruments to hedge or mitigate risk. They are not mutually exclusive. Actually, the best way is to do both. The distinction between the expected and unexpected is essential to deal with both. And on the mitigating hedging risk, also a very important message is most of the transactions that occur, I will not be talking about it, the book talks about managing longevity risk, are transactions in which insurance companies basically, or pension funds, in the case of most of the transaction in the UK, which is the main country going on, they transfer the totality of the risk to a reinsurer or an insurance company. What we argue, and you will be seeing, is that actually we should also be considering financial instruments that would allow is to partially hedge the risk. So what you call hedging and mitigating the risk, there is no need to transfer the entire risk. The risk can be managed internally and the unexpected part being dealt with financial instruments that allow to mitigate or hedge the risk. This is very important because first need to make sure mortality assumptions are in line with expectations to address expected improvements in life expectancy. So basically here what we're saying is we need to use actual and the best up-to-date data. Secondly, need to assess the financial impact of additional unexpected increases in life expectancy and decide how much risk to retain and mitigate. What this figure is trying to say is basically if you start using tables that are not up-to-date and don't incorporate of future improvements in mortality, you might be here. Then you do some calculations about future improvements, but because you are not using the actual more up-to-date and correct data, which, by the way, is the case in a large number of countries and pension funds and annuity providers, then you might come out saying, well, actually there is not much longevity risk. But the reality is that the reasonable estimate is this one, and when you do the projections, you are here. And then you do have a lot of potential longevity risk. So it's very important, first starting with actual adequate tables and actual and adequate data in order to assess the amount of longevity risk. Because if the starting point is wrong, we're not going anywhere. And then we do all the analysis and all the hedging and managing of the risk. So the main messages on the policy implication, I will develop them later on if I have time. First is the regulatory framework should ensure that pension funds and annuity providers use appropriate mortality tables, just what I just said, to account and provision for expected future improvements by establishing clear guidelines for the development of mortality tables used for reserving for annuity and pension liabilities. That's basically the role of regulators, pension funds or insurance companies. So the first thing what it's saying is we need to start using appropriate mortality tables. Second point is government should facilitate the measurement of mortality for the purposes of assumption setting and the evaluation of basis risk of index-based hedging instruments. We need data, basically what it's saying. And who has the best data? In most countries, governments. Not in every country, but in most countries, governments. In the UK, for example, the best data are provided by the CMI, which is the Association of Insurance Companies. The third point is essential. The regulatory framework should provide incentive for the management and mitigation of longevity risk. If mitigating longevity risk doesn't improve, doesn't reduce the amount of capital that you need to set aside or reserving or things like that, most pension funds and annuity providers will not do it. Why are you going to go into all this if it doesn't affect your risk profile and your solvency? Government should encourage the development of a market for instruments to hedge longevity, particularly index-based instruments, I will explain why, by facilitating transparency and standardization on longevity hedges in order to ensure the capacity for pension plans and annuity providers to continue provide longevity protection for individuals. This is one of the main messages for the panel session that we are having immediately afterwards. You need to make sure that insurance companies, annuity providers, are going to provide life annuities. And the only way they are going to do it is if they can hedge or mitigate longevity risk. So the government should help into this. So I don't know exactly how much time I have, but I'm going to go through each of the main messages, trying to elaborate them a little bit more. First, we have establishing guidelines for mortality tables. Tables should account for the expected future improvements. Analysis shows that tables which do not account for improvement risk having a shortfall of provision. For the countries we have looked into, accounting for mortality improvements at 2 to 2.5 years of life expectancy and age 65 on average. So that is quite substantial. And you can see what happened in many of the countries. Basically, what we're saying here is, again, we need to have tables that include future improvements in mortality and life expectancy. Tables should be regularly updated. This will ensure tables are in line with recent mortality experience and limit the impact of reserve increases. Again, the same message. We need good tables and up-to-date tables. Tables should be based on the relevant population, the discussion we had before, because it can vary quite substantially in some countries. Here are some of the variations. To facilitate the measure of mortality, accurate and timely mortality data should be available, preferably by age, gender, and socioeconomic groups. Could be used to inform mortality assumptions and keep them up to date. It's essential to keep them up to date. Mortality tables should be updated as regularly as possible. And we should do it as regularly. Not only we should have to have accurate mortality tables, we should update them as regularly as possible. Some countries do update them every 10 years, and every 10 years they realize that 1 year as 1 year of life expectancy increases pension funds and annuity providers have been reserving for a much lower improvements, and then after 10 years, there are problems. It's much easier to adjust €1 every month than the accumulated amount of euros over 10 years. This is very important. Obviously, we understand that it's going to be difficult. The level of education and income is significantly correlated with life expectancy, and we have data for the UK and for France, and of improvements in life expectancy also for the US and Israel and Canada. Those are the 5 countries. Because the differences by income or by educational level are quite substantial in some countries. In the US, for example, the data now shows that blue collars have actually a decrease in life expectancy in the last 2 decades, while if you use the average life expectancy, it's still showing big improvements. So it's quite important. Encouraging the management and mitigation of longevity risk, capital and funding requirements should reflect the risk profile of these liabilities. Assuming standards, accounting standards should ensure the appropriate valuation of hedging instruments. As this is again what I say, funding requirement and accounting standards should help in encouraging pension funds and annuity providers to use financial instruments to hedge longevity risk and to manage longevity risk. Facilitating the transparency and the standardization of longevity hedges, common options for hedging longevity, bulk annuities and longevity swaps. Most of the bulk annuities are a full transfer. That's what I was saying before. Buy-ins and buyouts. Basically, what the pension fund does is, or the insurance company, transfer the entire risk to the reinsurance. The insurance get the assets and gets also the responsibility or the liabilities. There is also longevity swaps that are being developed now. They are growing. The longevity swaps, from our point of view, they're better because you can hedge or mitigate. You don't need to transfer all risk. You can manage the risk internally and hedge for the unexpected part. Or if you want to hedge or mitigate some of the expected part, that's also fine. But you don't need to transfer the entire risk. And this is probably what most insurance companies will do. Fixed payment made by the pension fund annuity provider in exchange for floating. This is the problem here. We have longevity swaps is whether we are going to have bespoke swaps or index-based, and this is why we have the issue on the main recommendations that we endorse in index-based. There is a need for financial instruments to enable pension funds and annuity providers to mitigate risk because there are capacity constraints, limits to diversification, risk-based capital requirement, and increased focus on risk management. Basically, the idea here is there is always this argument that, well, who is going to provide the other side of the transfer? And there are no natural, maybe life insurance companies with their mortality or some health care providers. There is always this argument that there is not a natural institution or group of institutions on the other side of the transaction. That's completely true. This is what they call capacity constraints. But in financial markets, you always have primary markets, like in government bonds, and secondary markets. And what we're talking here is about secondary markets. In secondary markets, people can deal, sell, and buy all these instruments, and people can invest for different reasons than just hedging longevity risk. So that increases. But that brings us to the issues that I mentioned before, that you need a liquid market, a standardization, and transparency, because obviously we might have the financial crisis all over again, but from another sources. And the issue of bespoke and index-based is quite important. And it's important because there is a misalignment of incentive between pension funds and annuity providers and potential investors, the two sides of the transaction in a secondary market. Why? Well, basically, a pension fund will like to have a bespoke hedge because it will be exactly tailored to its annuitant or pensioner population, and they are fully hedged and they will not have any basis risk. The problem is there are limited data available on which to measure and assess the basis risk. And the second problem, most important, is that transaction will be quite expensive because it's just done specifically for that pension fund and annuity provider, and it cannot be transacted in a secondary market. And nobody will assess it. Actually, most of the transactions, they are not transparent because they are done, they are private dealings, private agreements, and that is the way it's done. Index-based instruments, and investors is the other way around. They would like to have instruments that are standard, that are easy to evaluate, and that can transfer or sell and buy them easily. So there is a misalignment of incentives. One will prefer bespoke, and the other one will prefer index-based. Index-based instruments, we believe, could resolve this misalignment and are by nature more transparent and standardized than bespoke transactions. And that's why we believe these instruments as the main way of financial instruments to hedge or mitigate longevity risk. Facilitating the transparency and the standardization of longevity hedges, the third part is that potential measures is we have regularly publish a longevity index to provide an anchor for pricing of longevity instruments. This is essential. People always argue there is a lot of longevity index, but they are, the index is publicly available. The projections of the index going forward is private property, so they are not available. Only when you go to the reinsurers or the financial institutions that did this kind of dealings, and then they will give it to you for a price. Metrics for both current mortality as well as projections reflecting the most up-to-date expectations is the key thing is the projections. Government have access to underlying data needed and could provide reliable and regular figures. Also, it's important to consider the issuance of longevity bonds to provide a benchmark for pricing, but of course, longevity bonds carry a problem. Nothing in economics have a pro. Nothing in economics is a free lunch. There is always pros and cons. There is a trade-off. We believe they must be considered with care given the significant existing exposure of many governments to longevity risk. Particularly in European countries, this might be quite problematic because at the end of the day, what you will be doing. Obviously, some people like David Blake in the UK argue that you don't have the government to issue longevity index bonds that will absorb all the longevity risk that is there. You can do it like in the inflation index government bonds, that you just have some issuance that become a benchmarking for transparency and standardization and allows for pricing and comparability. And it might only take 5% of the market, but the market will develop afterwards. That's a valid argument. There is the whole issue also, what is the idiosyncratic longevity risk and the cohort longevity risk. And in the cohort longevity risk, probably the only player out there that can manage it, it will be the government at the end of the day. But those are issues that are discussed in the paper. And of course, we also believe, given the experience of the last decade, that it's important to bring over-the-counter transactions into exchanges. It's essential to increase the transparency of such transactions and promote liquidity on the secondary market. And that's the issue I argued before. So this is the end of the presentation of what we do in this work at the OECD. As I say, we look at what pension funds and annuity providers do in terms of the regulatory mortality tables and the market practice mortality tables. Then we assess whether those tables expose pension funds and annuity providers to longevity risk by using 4 standard mortality projections models and comparing life expectancy and annuity premia that the tables they use and these models suggest they should be using. And then we discuss how to manage longevity risk internally using financial instruments to hedge, mitigate longevity risk. You don't need to transfer all the risk. You can use both. Probably that's the best way. And also how to promote or develop a secondary market for financial instruments that allow hedging for longevity risk. And the main takeaways of this work and of this presentation that I hope you can take with you, and if you do, my presentation has been successful. If not, well, I enjoy it. Thank you. First is expected longevity risk is unavoidable, and must be accounted for in mortality assumptions used to value pension and annuity liabilities. At current level, mortality tables should be regularly updated based on relevant data. Most of you might notice I repeat this quite a lot, but it is amazing to find out that mortality tables are not regularly updated in basically any country. It's essential to do it. Like inflation expectations are adjusted by central banks, this not. Obviously, inflation comes monthly, but annually, why not? Trend mortality improvements should be accounted for. As we say, many don't do it. So this is essential. You need to use appropriate tables and update them regularly. The regulatory framework should be reflective of and reactive to changes in exposure to unexpected longevity risk to encourage the measurement and management of risk. Accounting standard and solvency requirements should help here. And if they need to be adjusted, it will be a good idea. The transparency and standardization of longevity hedges should be facilitated to ensure available capacity for longevity risk. Data availability, reliable benchmark, and standardization through exchanges are key messages here. So these are the three building blocks. We believe this is very important, so these are the three main messages. Thank you very much. Any questions, comments? Very welcome.
Muchísimas gracias, don Pablo. Un parcito de preguntas, damas y caballeros, si tienen ustedes por acá algún comentario. El caballero.
I don't know if I have to make the question in English or Spanish.
En el idioma que quieras.
Well, we do it in English as your speech. So thank you very much for your explanation. I think it's very interesting, and considering my point of view as European, Spanish, and reinsurer for many years, I'm quite interested to know why did you explain about longevity mitigation using financial tools and not reinsurance. I don't think that I missed your point, but in Europe, most of transactions have been made through reinsurance based on longevity swaps, index swaps, and mathematical provision swaps. And so it's, and I have also another point. You made a very interesting suggestion. I fully agree with you in relation to the need of mortality tables update. But in Europe, we have another point of view. You're fully right, but communication. You know, at least in Spain, people do not realize about the longevity, so they believe that we are here only for 60 or 70 years, and perhaps we have to look at Japan and realize that in a very short, new babies have a very long life expectancy. over 100 years, probably. So these 2 points, communication to the people, to the normal people, I think that you don't have this issue in Chile. We do have this issue at least in Spain and neighboring countries. And about the reinsurance as a mitigation tool.
Starting with the second issue, I completely agree. Communication is everything. All countries are bad. In every country, every survey shows that the population on average believes that the life expectancy is much below the average of the life expectancy in the country. In a country like Spain, people should know better because women tend to live quite longer, as you probably know. And when you look at the data, at this moment, maybe not in the next generations, but at this moment, the third higher life expectancy of women after Japan and France are Spanish women. But communication is everything. That's the point that of the first issue is to acknowledge that there is improvements in life expectancy. Here we only focus on what pension funds and annuity provider, but in the populations in general, that's true. And in public pension systems like in Spain, the pay-as-you-go, and most European countries, France, Italy, it's essential. And people don't realize that if you live longer, well, money has to come from somewhere. On the reinsurance, if I understand correctly, the point I try to make is, yes, there is a lot of transfers, full transfer, buy-ins and buyouts, and also swaps, but they are based on buy-ins and buyouts. Because basically what they do is they transfer fully the assets and the liabilities. We do not believe this is a long-term solution to develop a full market to hedge longevity risk. When we say hedging or mitigating longevity risk, we mean let's assume if you have 10, whatever, units of longevity risk, you only hedge 1 unit. The other 9, you do it internally. You can either get the 10 and transfer to a reinsurance company through those hedges, but we don't think this is the future in terms of hedging and mitigating the risk, because some insurance company and pension funds might want to do it themselves. I can manage internally the expected component of longevity risk by updating tables regularly, setting capital, and having accurate tables. I can do it myself, and that probably it's more efficient, and insurance companies have the experience. And the unexpected part, you can hedge it, the 1 or 2 units of those 10 potential units of longevity risk. What they do now, you're completely right. In most countries, in Europe, in the US, is the full transfer is through a reinsurance. But those are not standard. They are bespoke, and they are private deals, so nobody knows about the actual parameters involved in them. They're private information.
Thank you. That's very interesting presentation. 2 questions. To what extent, I understand your research is very much focused on longevity risk, but all of us know that the huge potential risk in annuity and pension is interest rate risk. And now low interest rate environment, people say that it will continue for a long period of time. So I understand that not focusing on longevity issue, but more sort of shortage of financial means in terms of pensions and annuities, interest rate risk is considerably big. So first question is, to what extent your research is taking into account this interest rate risk? And second, your first recommendation is updating the mortality risk. And some people clearly say the same thing for interest rate risk. Some interest rate is lock-in. Whenever, let's say, interest rate is very high environment, 3-4%, and now, 1-2%, and those lock-in and 20-30 years, and currently 1%, 2%. It's a huge potential risk. So how do you see, in your view, this interest rate with the analogy of your longevity risk recommendation? Thanks.
I could have a completely full presentation now. Actually, we are publishing in the Financial Affairs Division in the middle of June the Financial Affairs Outlook. And one of the chapters, which I'm one of the authors, is about the impact of interest rate risk on pension funds and annuity providers and insurance companies. So it's exactly what you're saying. The chapter is already written, it's just in the publication process. And even in that chapter, we have a section in which you use all this modeling and that table there, and we assess how it changes our assessment of the different mortality tables when we increase and decrease. So we assess the sensitivity on interest rates. The impact of interest rates is extremely important on pension funds and annuity providers because obviously you have the impact on the asset side, which is basically what you have is you have the current value of the assets to cover future liabilities. And of course, on the asset side, you have part of the portfolio invested on instruments that their return is based on the yield, fixed income. And there are going to be changes there. But of course, you also have the reinvestment risk because you might have bought Spanish government bonds, Greek government bonds 2 years ago, and now you have a portfolio of government bonds, Italians, of yielding 6 and 7%. And you, whatever guarantees you have given in your liabilities, you're great. But of course, in 10 years' time, if interest rates remain low, those bonds expire and you will have to buy into bonds which are much, much lower yield, let's say 1% as you say, and your guarantees is still at 4%. So you're doomed. That's but on the liability sides, the impact, it depends on the nature of the promise. And here the world of pensions and insurance is completely different because in most countries as a result of the crisis, the several crises on pension during the 2000s, the typical example is the Netherlands, that was a pure DB final salary and now the promise is not written in stone anymore, it's exactly that. The promise is not anymore written in stone. It can be adjusted. In the insurance world, it's much more complicated because the promise is given. New contracts are adjusted on life annuities, for example, are adjusted to the new environment. And if insurance companies do not take into account that maybe interest rates are going to be, at least in the European context, for the next 10 or 20 years at 1 or 2%, well, they're doing something wrong. And if it goes past, it's because they're doing something. But the past promises is a very serious problem. So you either renegotiate them or I don't know how they're going to cover them. Obviously, there's one solution, but that solution is very problematic, and that is something we discuss in another chapter in the financial outlook, is the search for yield, that insurance companies, pension funds, and other institutional investors are going to go out and invest in other assets or investments that yield higher returns, but they are riskier. And that might create another set of problems that can be very, very dangerous. That is a grosso modo, but I will be happy to send you the chapter when it's ready.
I am Natalie from SUSEP, Brazil. And there is some point that was not very clear to me during your exposition. And it relates to that slide that you showed the comparison amongst the countries in terms of the requirements of mortality tables. So in Brazil, we have minimum level requirements and improvement requirements for mortality tables. And it says that for annuity providers and for pension plans, we should not have these ones. So all the data that we use are provided by the industry, and mortality and survival tables are constructed by the Federal University of Rio de Janeiro. And they are now developing the disabled tables, and all of them presents data for male and female versions. And we have also the evaluation of that additional reserves that we mentioned that calculates the difference between the risk that was former evaluated by the industry and the one that is really in course. And this is calculated by the industry every 3 months by the liability adequacy test. And in order to help the industry to calculate these numbers, we also developed our own interest rate term structure. So we are asking why you are just putting no for Brazil.
We checked this with the Brazilian regulator, but we put yes for pensions. Yeah, ABRAPI is the pension plans. No, it's not. ABRAPI is not a regulator. I know it's not a regulator. I'm just saying that we know from ABRAPI that pension funds have minimum requirements, and we say yes here. It's for insurance companies in which we don't, annuity providers, we don't have. If you have information, I'm very happy to discuss with the information we have in the publication. And the tables that we have in the figure for Brazil, they are the ones. If you have all this is information available up to May 2014. So if you have
Every 5 years our tables are updated.
So if we can discuss looking at I have the publication there, and I will be happy to include Better Brazil. Thank you.